No one heard the mistake when it happened. There was no explosion, no screaming headline, no sudden collapse of buildings or banks. It occurred quietly, inside conference rooms lined with polished wood, inside documents stamped with authority, inside decisions that felt reasonable at the time. And yet, that single financial mistake would ripple outward, slowly, invisibly, until it came terrifyingly close to tearing the United States apart. The year did not feel dangerous. The streets were busy, factories ran, trains moved, families planned futures. America looked strong, confident, unbreakable. That illusion was the most dangerous part. The men who made the decision were not villains. They were respected, educated, patriotic. They believed they were stabilizing the system, smoothing rough edges, preventing chaos. They trusted numbers more than human behavior, models more than memory, and confidence more than caution. And in doing so, they forgot something history never forgives. Money does not behave the way people expect it to when fear enters the room. At first, the signs were subtle. Small banks tightened lending, credit slowed just a little. Farmers noticed prices slipping. Factory owners delayed expansion. None of this felt catastrophic. In fact, many economists called it healthy correction, a pause, a reset, something necessary. But beneath the surface, pressure was building. America had grown addicted to leverage. Easy credit had become normal. Debt no longer felt dangerous, it felt productive. People borrowed to invest, invested to grow, and grew because they borrowed more. It worked beautifully, until it didn't. And the mistake was not borrowing itself. The mistake was assuming confidence could replace caution indefinitely. Inside financial institutions, risk was being misunderstood. Assets were bundled, repackaged, and labeled safe because everyone agreed they were safe. That agreement became the foundation of the system, not reality, not fundamentals, just belief. When belief holds, systems thrive. When belief breaks, systems collapse violently. The first cracks appeared where no one was looking, a missed payment here, a delayed shipment there. Small failures that should have triggered alarms were dismissed as anomalies. Models said everything was fine, and models, after all, had degrees and equations. Human instinct did not. By the time fear entered the system, it didn't announce itself. It whispered. It moved quietly from desk to desk, from bank to bank, from investor to investor. One man decided to pull back. Another followed. Liquidity dried up, not because money disappeared, but because trust did. And once trust is gone, money stops moving. That was the moment the mistake revealed itself. The decision, once praised as innovative, had created a fragile structure where too many institutions depended on uninterrupted confidence. There was no margin for panic, no buffer for doubt. When hesitation spread, the entire structure trembled. Banks stopped lending to each other. Companies couldn't meet payroll. Ordinary Americans who had nothing to do with the decision began feeling the consequences first. Jobs vanished. Savings evaporated. Homes became burdens instead of dreams. Still, leaders insisted the situation was under control. They said it would pass. It didn't. What made the mistake so dangerous was not its scale, but its timing. It came at a moment when the American economy was deeply interconnected. One failure cascaded into another. A local problem became a national emergency. A financial issue transformed into a social one. Panic does not need logic, it needs permission. And permission came the moment people realized the system they trusted might not protect them. Lines formed outside banks, newspapers screamed, markets plunged, confidence collapsed faster than any model predicted. What had once been theoretical risk became lived reality.
Inside government offices, officials scrambled. Emergency meetings stretched into sleepless nights. Decisions were made under pressure, often with incomplete information. Every option carried consequences. Act too slowly, and collapse accelerated. Act too quickly, and confidence shattered further. America stood on the edge, not because it lacked resources, but because it had misjudged risk. The financial mistake had done what wars, enemies, and political divisions could not. It had shaken the foundation of belief. People began to ask questions they had never asked before. Is the system fair? Is it stable? Is it designed for people or for numbers? Trust, once broken, does not return easily. And as the crisis deepened, it became clear that this was no longer just about money. It was about identity, about whether the American promise still held meaning when the system failed the very people who believed in it most. The mistake had exposed something terrifying. Prosperity without resilience is an illusion, and the country was about to learn that lesson the hard way.
The moment confidence collapsed, everything accelerated. What had taken years to build began to unravel in weeks. What had taken weeks to weaken began to collapse in days. And what had taken days to panic happened in hours. Banks that had once lent freely now refused even their closest partners. Overnight lending froze. Phones rang endlessly in trading floors, not with deals, but with fear. Numbers on screens turned red, then darker, then meaningless. Markets were no longer reacting to logic, they were reacting to survival. Ordinary Americans felt it first, as they always do. A factory shut down without warning. A paycheck didn't arrive. A mortgage payment suddenly became impossible. Families who had done everything right found themselves punished for a mistake they never made and never understood. The financial system had been built on the assumption that liquidity would always be there, that someone, somewhere would always buy, lend, or insure. That assumption died quietly, without ceremony, and once it was gone, the system had no memory of how to function without it. Inside Washington, the mood turned grim. Emergency meetings replaced routine schedules. Economists argued fiercely, not over theories anymore, but over damage control. There was no perfect solution. Every option carried risk. Inject money and risk inflation and moral outrage. Do nothing and watch the system collapse entirely. The terrifying truth was this: no one truly knew how deep the damage went. Financial institutions themselves didn't understand their own exposure. Assets had been sliced, bundled, and sold so many times that ownership became abstract. Risk had been disguised as safety. When the music stopped, no one knew who was holding the liability. Fear spread faster than information. Investors pulled money not because they had facts, but because others were pulling money. Businesses laid off workers not because they were bankrupt, but because they feared becoming bankrupt. Panic became self-fulfilling. The mistake had turned fear into fuel. Then came the moment that nearly broke the country. A major institution, one considered too stable to fail, teetered on the edge. Its collapse would not just erase wealth, it would erase trust entirely. If it fell, confidence in the entire system would evaporate. International markets watched closely. Allies grew nervous. Enemies paid attention. The question was no longer economic, it was existential. Should the government intervene? To many Americans, the idea felt like betrayal. Bailouts sounded like rewards for failure. Why should reckless institutions be saved while ordinary people suffered? The anger was justified, but the alternative was unthinkable. If the institution fell, it would pull others with it. Banks, businesses, pensions, savings. The ripple would be uncontrollable. America would not just enter recession, it would enter chaos. The decision was made under unbearable pressure.
Money was injected, guarantees were issued, emergency powers were invoked, trillions were committed with signatures that shook as they were written. The goal was simple: stop the bleeding long enough to restore confidence. But confidence is not restored by money alone. People watched the news in disbelief. Markets swung violently. One day hope surged, the next despair returned. Protests erupted, faith in leadership eroded, the social fabric stretched thin. For the first time in generations, Americans questioned whether the system was rigged beyond repair. The mistake had revealed something deeply unsettling. The economy was not a machine, it was a collective belief. And belief, once fractured, does not heal easily. Even as the immediate collapse was slowed, the damage lingered. Jobs did not return quickly. Homes remained underwater. Wealth inequality widened. The recovery favored those closest to capital, leaving millions behind. The near destruction of America had not come from invasion or war. It had come from a misjudgment, a financial decision made with good intentions and flawed assumptions. History would later debate responsibility. Names would be analyzed, policies would be rewritten, safeguards would be promised, but none of that erased the truth that haunted the nation. One mistake, quiet, technical, seemingly reasonable, had almost destroyed everything. And the most dangerous part was this: it could happen again. Because systems forget pain faster than people do. As the country struggled to recover, a deeper question remained unanswered. Had America learned the right lesson, or had it merely postponed the consequences? That question would define the next chapter. The collapse did not end when the market stopped falling. That was the illusion many wanted to believe. The screens turned green again, headlines softened, politicians spoke of recovery. But underneath the surface, the damage continued to spread, quietly, patiently, reshaping the country in ways numbers could not capture. Recovery, as it turned out, was uneven. For Wall Street, it arrived first. Capital flows resumed. Institutions that had stood at the edge of extinction found themselves alive again, supported by emergency lifelines that had been unimaginable months earlier. Bonuses quietly returned. Confidence crept back into boardrooms. The system, at least at the top, stabilized. For ordinary Americans, recovery felt like a rumor. Factories reopened slowly, if at all. Jobs returned at lower wages. Homes that had once represented security became anchors of debt. Entire communities hollowed out as people moved in search of work that no longer existed. The financial mistake had not just broken markets, it had fractured trust between citizens and the institutions meant to protect them. People began to notice something unsettling. Those who caused the collapse survived. Those who did not suffered the consequences. This realization planted a quiet bitterness across the country. It wasn't loud at first. It didn't erupt immediately. It simmered. It reshaped conversations at dinner tables, in break rooms, in quiet moments of reflection. Faith in fairness eroded. The system had been saved, but the people felt abandoned. Economists debated policy successes. Charts showed stabilization. GDP recovered. But statistics could not measure resentment. They could not quantify the psychological cost of watching life savings evaporate while institutions were rescued with public money. The mistake had created a moral fracture. As years passed, that fracture widened. Wealth concentrated faster than ever before. Asset prices soared, benefiting those who already owned them. Wages lagged, opportunity narrowed. The same leverage that had once fueled growth now magnified inequality. The system, rebuilt quickly but not redesigned deeply enough, resumed its old habits. Regulations were promised, some were implemented, many were weakened over time. Memory faded, lobbyists returned, complexity crept back into finance, wearing new names but carrying old risks. Human behavior, unchanged by policy, quietly prepared the conditions for repetition. The most dangerous part of the mistake was not what it destroyed, but what it taught the wrong people. Institutions learned they would be rescued, risk-taking returned, emboldened by precedent. The fear that should have corrected behavior softened into confidence that collapse could always be managed. Ordinary Americans learned something else entirely. They learned that the system did not protect them equally, that losses were permanent while gains were privatized, that stability was conditional, that security depended not on effort alone, but on proximity to power. This realization reshaped politics, culture, and identity. Distrust grew, anger found targets, narratives hardened. The financial mistake echoed far beyond economics, influencing elections, social movements, and national cohesion. America had not just suffered a financial crisis, it had suffered a crisis of belief. And belief, once shaken, changes behavior. People saved less or hoarded more. Others withdrew entirely from institutions they no longer trusted. Risk-taking declined where it should have existed and exploded where it should not have. The balance was lost. Meanwhile, a new generation grew up in the shadow of the collapse. They watched parents struggle. They inherited skepticism. They questioned promises that previous generations had accepted without hesitation. The American dream no longer felt guaranteed. It felt conditional, fragile, uncertain. Historians would later argue that this was the true aftermath of the mistake. Not the recession, not the bailouts, not even the near collapse, but the slow erosion of trust. And yet, the story did not end in despair. Within the wreckage, lessons existed, hard-earned, painful, and essential. Some policymakers listened, safeguards improved, transparency increased in pockets, stress tests were introduced, early warning systems became more sophisticated. The system, scarred but wiser, gained some resilience. But resilience is not immunity. The financial mistake had proven something fundamental. A modern economy is only as strong as its weakest assumption. When confidence replaces caution, when models replace humility, when growth outruns understanding, collapse becomes inevitable. The country stood at a crossroads. Either it would remember the pain long enough to change behavior permanently, or it would forget just enough to repeat it. As years passed, signs of forgetting emerged. Debt climbed again, leverage crept upward, new instruments promised safety through complexity, familiar language returned, dressed in innovation. The system began to look stable once more. Too stable, and those who remembered the collapse watched nervously, knowing that history does not repeat exactly, but it does rhyme. The financial mistake had almost destroyed America once. The question that remained was hauntingly simple. Had America truly learned from it, or merely survived it? That answer would determine whether the next mistake would be survivable at all.
The final lesson of the mistake did not arrive with another crash. That was the most deceptive part. There was no single morning when America woke up to a new collapse, no dramatic countdown, no sudden blackout of the system. Instead, the danger returned quietly. It returned in the form of comfort. Years after the crisis, stability itself became suspiciously familiar. Markets rose, credit flowed freely again. Technology accelerated finance beyond human speed. Algorithms made decisions once handled by cautious hands. Risk was sliced thinner, spread wider, and hidden deeper. Confidence returned faster than wisdom. The generation that had lived through the collapse still remembered the fear, but the next generation only knew the recovery. For them, the crisis was a chapter in textbooks, not a scar. And history has always been most vulnerable when memory fades faster than behavior changes. The system began to rely once again on assumptions, that housing prices would remain stable, that liquidity would always exist, that innovation could eliminate risk rather than disguise it, that someone, somewhere would step in if things went wrong. These assumptions were not malicious, they were human, and that is why they were dangerous. The original financial mistake had not been caused by a single villain or a single decision. It was caused by a chain of rational choices made under shared illusions. Each link looked safe on its own. Together, they formed a weapon powerful enough to destabilize a nation. America learned, too late, that complexity without accountability is fragile. The deeper truth was uncomfortable. The system was not broken by accident. It was built to prioritize growth over resilience, speed over understanding, profit over patience. The mistake exposed that design. And redesigning a system is far harder than rescuing it. Some reforms endured, capital requirements increased, stress testing became routine, oversight improved in key areas. But over time, pressure mounted to loosen constraints in the name of competitiveness and growth. Old arguments returned, polished and persuasive. We're safer now. This time is different. We've learned our lesson. Those words had been spoken before. Meanwhile, the world watched America closely. The mistake had not only threatened a nation, it had shaken the global economy. Trust in American financial leadership was damaged, though never fully replaced. The dollar remained dominant, but faith was thinner, more conditional. Power survived, but authority weakened. Inside the country, the long shadow of the mistake continued to shape lives. Political polarization intensified. Economic debates hardened into identity battles. Every downturn, no matter how small, triggered echoes of past fear. Stability became fragile not because of markets, but because of memory. The crisis had taught Americans something fundamental about vulnerability. That even the strongest system can fail. That expertise does not guarantee wisdom. That safeguards matter only when respected, not when ignored. And above all, that financial mistakes are never purely financial. They rewrite lives, they reshape nations, they alter the future long after the numbers recover. The most sobering realization came slowly, almost reluctantly. America had not been destroyed because the system held, barely. But survival came at a cost. Trust was spent like currency, and it has been harder to replenish than capital. The near destruction forced a choice. Either the country would accept slower, safer growth, or continue chasing speed while hoping rescue would always arrive in time. History suggests hope is not a strategy. The mistake nearly ended the American experiment not because it involved money, but because it tested belief. Belief in fairness, belief in responsibility, belief that the rules apply equally. That belief cracked, but did not completely shatter. And perhaps that is the most important part of the story. America survived not because it was invincible, but because enough people recognized the danger before it was too late. The system bent instead of breaking. Pain forced reflection. Reflection forced change. Imperfect, incomplete, but real. The lesson remains, waiting patiently. The next crisis will not announce itself. The next mistake will look reasonable. The next warning will be easy to ignore. And whether America survives again will depend on a single question, just as it did before. Has the country learned to fear the right things or only the last collapse? Because the most dangerous financial mistake is never the one that already happened. It is the one people believe can never happen again.